Hey everybody, Jason Fieber here, founder of Dividend Mantra, founder and publisher of Mr. Free at 33, and of course I write the Undervalued Dividend Growth Stock of the Week articles for Daily Trade Alert. Welcome to another video today. This is part of an ongoing video series that we're doing, which is complementary to the Undervalued Dividend Growth Stock of the Week articles, which you can find if you're at Daily Trade Alert. Once you go under the Dividend Growth Investing heading there, if you look at the tab here, you've got the Undervalued Dividend Growth Stock of the Week. If you click on that, it'll take you to this page here. And it's got all of the Undervalued Dividend Growth Stock of the Week articles that I've written since going back to October of 2014. So we've been going a few years strong here, which is awesome. And you can scroll through all the stocks I've written about, pull up any of the articles you'd like, read through some of the analysis and the conclusions insofar as the valuation goes, and go from there. And we've been doing these articles for quite a while, and we would get some emails asking questions about where the numbers came from or where the valuation comes from, so on and so forth. So this video series is designed to complement those articles and take you readers step by step into where the conclusion came from, where the numbers come from, where the valuation comes from, and wrapping it all up, pulling it all together, which I think helps the articles. It makes them a little stronger, and that way, if there's any questions or anything like that, this video series should answer those questions pretty conclusively. So, and you can see a couple of the videos, or a few of the videos actually, that we've already done. We did one on CVS, I did one on Disney, and then there's one on Magna here back in May. That was the first one that we did. And so today we're doing another video. The stock that I picked to do the video on today is GWW Grainger, which was the Undervalued Dividend Growth Stock for July 23rd, that week of July 23rd. These are published every Sunday. So if we click on that article, which I already did, we can go over to the article, which this article is on GWW Grainger. So I'm going to click off the tab here. And so when I start off every article, as I've talked about before, every article starts off with a big idea. Why should we be interested in saving and investing? What's that going to do for our lives? How's that going to positively impact our lives? Where's the buy-in? Why should readers be interested in this stuff? What can it do for you? And stuff like that. So I talk a little bit about, kind of dividend growth investing in my view is really one of the most simplistic ways of investing on one hand, and also one of the most robust and really most intelligent ways to go about long-term investing. It's been, they've done some studies on it when looking at high-quality stocks that pay and grow dividends, and they typically outperform the broader market over the long haul. So you're taking what's really a very simple idea, investing in great businesses, for the most part, blue chip stocks that are, paying shareholders a portion of their profit, and as that profit grows, so do the dividends. So you're taking a very straightforward idea. Even a 9-year-old would say, oh yeah, well, I know of Apple. 9-year-olds, I think today I see some of them walking around with smartphones, so they're probably pretty familiar with Apple and iPhones and whatnot. So, you can take a kid almost, and if a kid can kind of draw a business model and figure out what a business does and say, okay, yeah, that's a pretty good business. A lot of people buy it, buy their stuff. When you take something like that simple, the point of the article that I wrote with WW Grainger, the point of the big idea that I started the article off with is that you don't need to overcomplicate things. You don't need to get into crazy investments, and it's not necessarily a thing where the more difficult or the more complicated it is, the better your return's going to be or the better off you'll be. In fact, it's usually the opposite. So that's kind of what I was talking about with the first part of the article here. And then we get into, why undervaluation is important. Once you kind of buy into the idea of dividend growth investing, it's important then to not only look for, good companies that are within your circle of competence, that have the high quality fundamentals, that have those competitive advantages. It's also important to look at valuation because, even if you pick out a really good business, if you're paying way too much for the stock, your investment return and your income and your risk, all of that stuff's going to suffer negatively. So we talk a little bit about why undervaluation is important, which leads into the video today. What we're getting into now is we're getting into WW Grainger. I start off every analysis with a basic rundown of what that business model is all about. How do they make money? What's the company's story? What is it all about? And so WW Grainger is the largest global distributor of maintenance, repair, and operating supplies and related products and supplies. So they're getting into MRO. MRO is a multi-billion-dollar industry worldwide. A highly fragmented industry, though. Even though WW Grainger's the largest out there globally, they only have about 3% of the global market share. So it's a humongous industry, but a lot of individual players, with no player having really kind of a stranglehold on the market. So when we think about oligopolies, or even maybe a monopoly, when you think about an oligopoly like the United States telecom market, where you have AT&T and T and Verizon, and then you have a couple of smaller players, T-Mobile and Sprint, but you have basically just a couple of major players there owning the market. Well, this would be the opposite of that. So pros and cons of that, the benefit of that is that there's a lot of room for consolidation and growth, because you've got little slivers of the market here and there that as a player becomes bigger, they can kind of swallow up those smaller competitors. So there's that long runway for growth and expansion. But on the drawback side of it is that you've got a lot of competition, limited pricing power, and stuff like that. So always pros and cons, always trade-offs to consider whenever you're looking at a business. Whatever industry it's in, whatever the company's doing. But WW Grainger, that all being said, is a really, really wonderful business. They are a middleman, which is looking at things all in all. When you look at distributors, it's really one of my least favorite business models, because you're typically looking at pretty thin margins, because they can be kind of a price taker. They're competing on price when you're getting into distribution. That said, WW Grainger does it really, really well. They built up an incredible business model based around that. They also have a lot of private label MROs, so they have a lot of private label supplies and machinery and things like that their customers like, and that they buy repeatedly. So, and that actually makes up a pretty good chunk of the overall parts and supplies that they sell. So I get into that a little bit here, and when you pull up their most recent annual report, which I've got right here, which was for 2016, when you pull it up, this is the first couple pages into it. And how I got that, guys, if you pull up Grainger's investor relations site and you go under annual reports and proxies and SEC filings, you can find all their annual reports. And the one I pulled up for today, of course, was 2016. And whenever I do these articles, I look at 10 years of revenue and profit growth, which I consider 10 years a pretty good proxy for the long haul. So obviously I have to have two annual reports pulled up. I have to have one from 10 years ago and then one today, or the most recent fiscal year, I should say, and which is 2016 for WW Grainger. So they kind of break their business model down a little bit in the first couple of pages, which is you see item 1, business, the company. They talk a little bit about the company, incorporated in 1928. So they're going back quite a ways there. They talk a little bit about what they do, and they break down their different areas of the world, with the United States being by far the largest part of that business. So you got the United States right here. You got United States business offers a broad selection of MRO supplies and other related products and services through sales and representatives, catalog, e-commerce, and local branches. And this two last parts here, e-commerce and local branches, that's important to consider, because the business model for WW Grainger is changing a little bit, and that's something that has affected their stock price a little bit. And when we go over to Google Finance, of course, in the prior videos, you can see all the tools I have here, which I've already pulled up all the sites. When you look at their 1-year stock price, when you see their 1-year stock chart here, you see that major dip there. And a lot of that from reading a couple of the recent financial reports and kind of reading through what investors are talking about, that's really due to concern on margin compression, which is the margins are compressing due to the onslaught of continued competition and price of an e-commerce, and specifically Amazon Business, their new offering where they're getting into this line of business which is competing against WW Grainger. When Amazon moves into an industry, they become thought of as the 800-pound gorilla or whatever, even though they might not be. And as we saw, this is a highly fragmented industry. For Amazon to just come in and just swallow up the whole industry would be highly unlikely. That said, they don't have to. They come in and they start competing, and that compresses WW Grainger's margins because it's more competition. They're competing on price even more than they already were. And any businesses that already maybe rely on Amazon for any other types of supplies, if they're offering that Amazon business side and they're offering the MRO, that becomes a more competitive marketplace for WW Grainger. So, looking forward, as Amazon Business moves into these areas, it's probably going to be an overall negative for WW Grainger. But what I talk about in the article a little bit, and what they lay out when they talk about e-commerce, what I lay out in the article, is that they already have 65% of the company's orders that originate online. So they're already pretty strong in e-commerce. Their site, WW Grainger's website, is the 10th largest e-commerce retailer in North America. So, they're already a big player online. So they're already doing a lot of their business online. So, customers will order it and they'll either ship it, try to get it next day, or they have their local, these humongous industrial centers that are spread across the country where customers can also pick up their orders. And WW Grainger aims for same day service. So, and actually I used to work in the auto business. I used to work for I used to work for a dealership in Ann Arbor, Michigan that was not too far from, really right around the corner from a WW Grainger site. And so we would order stuff all the time from them, and then we would just drive over and pick it up, and we try to get same day service from them. So, and we had an account with them and everything. So I have some personal experience with that on that side of things. But so the thought of Amazon Business coming in and just taking a wrecking ball to the whole industry and WW Grainger going out of business or something, I find that incredibly unlikely. But it doesn't really need to happen for WW Grainger's business to take a hit and for their stock price to take a hit and for the valuation to come down and everything else, because as their growth becomes stunted a little bit, as their margins compress, that impacts the valuation, because a faster growing business deserves a higher valuation than a slower growing business. So WW Grainger's valuation compresses as the margins and the growth compresses. So that's kind of what's happening here. So when I look at this chart here, when I see this drop, some of it's warranted. The stock is down. We can see here almost 25% over the last year. Some of that is warranted, definitely, because I think Grainger is going to be negatively impacted by some of these moves. But a quarter of the business, this is a company with currently a market cap of 10 billion. So if you take that, that 25% that was lopped off, call it 12 and a half. That's you're talking, we're getting into a few $1 billion here, and that seems to be a little overdone. So the stock may have been a little expensive before, which leads me back to the original point of why you shouldn't pay too much. And investors buying in Grainger at 200 and almost $60 a share here not too long ago, earlier this year, probably paying too much for the stock. And when you buy an overvalued stock with some concerns about where it's going forward, that's where you kind of get in trouble sometimes, because you're not just looking at maybe a capital loss there, but you're adding risk, and also you're limiting your income potential, because Grainger yields just a little over 3% today, which seems to be pretty reasonable for what they're probably going to do going forward. But when you're getting a yield far below 3% on some on some upcoming concerns, it's maybe something you don't want to get into. So just something to keep in mind there. So what we're getting into, when we go back to the article here, I talk a little bit about what they do, how the industry is pretty fragmented, that they're a distributor, and I also talk about the e-commerce threat, how it might be overdone, but it's going to, I think it's definitely going to negatively impact WW Grainger. I don't think there's a doubt about that. It's just to what degree, and whether the valuation of the stock is appealing right now, even factoring some of that in, which, keeping in mind, I'm just, one investor. I'm just one, writer about this stuff. So my perspective is limited to just what I think about it. But, what actually happens in real life, it's hard to tell. I mean, we basically just take a look at what we have, what information we have on the table, and try to forecast that out moving forward. But how that actually works going forward, it's hard to say. So the next thing I get into with every article is the dividend metrics, which of course, as a dividend growth investor, is a primary concern. I want to know, how long a company has been increasing its dividend. I want to know the yield. I want to know the dividend growth rate looking out over the long term. Again, we're talking 10 years generally here as a proxy. And then I want to know how sustainable that dividend and dividend growth is by looking at the payout ratio, then looking at overall underlying growth going forward, which will support that dividend growth as the years go on. So we get into how long they've been increasing their dividend for, which for Grainger's 46 consecutive years. And you can pull up David Fish's Dividend Champions, Contenders, and Challengers list to get that information. And you see WW Grainger here. You see 46 years of consecutive dividend growth, which is, talking almost 50 years now. There's not a lot of companies out there that have that kind of dividend growth. In fact, you see a couple just below Grainger with similar numbers. We're talking Walgreens and Walmart. So these are global behemoths. getting into that kind of area. And actually, WW Grainger exceeds both those metrics. So WW Grainger has a longer dividend growth streak than Walmart, which, that should kind of tell you something right off the bat, right? So it's a pretty incredible dividend growth streak, obviously, very impressive. And then we get into the 10-year dividend growth rate, which we can see here, 15.8%. You can see where they got that number from. The concern, though, is that while 15.8% is phenomenal for a 10-year dividend growth rate, and anybody who bought Grainger 10 years ago has been experiencing that dividend growth, which is excellent, you see a sharp deceleration here. The 5-year dividend growth rate of 13.9% right here. You see a 3-year dividend growth rate of 10.4%, and then you see a 1-year dividend growth rate of 5.2%. And then the most recent dividend increase was only 5%. So that's something to keep an eye on. They've got a very moderate payout ratio of a little over 50%, which I actually consider that's pretty close to perfect, a perfect harmony between retaining profit to reinvest back in the company and then paying out shareholders their rightful share of that profit. So you've got a very almost even split between the company keeping profit and the company returning profit to shareholders, which are the collective owners of any publicly traded company. That's a pretty good number, but that deceleration there is really, it's not good. I mean, I don't know how else you want to really put it, but it's definitely unappealing. It's unattractive. It's not something I really am, it's not something I get excited about. I'll say that. I'd rather see an acceleration, not a deceleration here when we're talking about dividend increases. So, you're looking at a company that's pretty mature. It's in a fragmented industry. It's competing on price. It's got additional headwinds via Amazon Business, and you've got that deceleration that's already started to occur, which doesn't bode well for an acceleration. But if Grainger can still grow its profit, in the mid-single digits or so, say 5 to 7% going forward, that still leaves room for that dividend to grow at least in that range just based on the moderate payout ratio. In fact, this payout ratio could expand just a little bit without any real concern. I mean, they could take that up to probably 60, 70% unless they're going to radically change the business or somehow, massively reinvest in the business, because that'll limit, as that payout ratio increases, that starts to limit the retained earnings, or it starts to, limit how much profit the company keeps to grow the business. So a business always has to keep those two numbers in mind. There's a dynamic there between keeping profit and paying profit out to the shareholders. And they've got that dynamic pretty evenly split right now, which is fantastic. But, they could expand on that a little bit. I wouldn't want to see it go up too much, but there is some room there to play with. And then we get into we get into the payout ratio there, 52.4%, which you can also find if you take the trailing 12 months earnings, $8.69 earnings per share, you take the quarterly dividend of $1.28, multiply those out. So you've got an annual dividend of $5.12 divided by TTM EPS, which is $8.69. So you've got a payout ratio there. So that's come down a little bit since I last wrote that. I have to look in that a little bit, but the payout ratio is somewhere in the 50s right now, which again is pretty close to perfect. And then we've got the yield right now, 3.15%. When I wrote the article, it's currently at 3.10%. So the yield's down a little bit since I published the article, which means the stock's moved up just a hair. And then when we get into that yield, something else I talk about when I write the articles is comparing that current yield to the recent historical average yield for that particular stock. So if a stock currently offers a yield of, let's say, 4%, and over the last 5 years it's averaged 2%, there's obviously a major disconnect there between what investors have typically been willing to accept as far as yield, as far as income goes on a stock, compared to what they're willing to accept today. So, did something happen to the business? Did something, strongly negatively occur? Is there some type of, like Wells Fargo, for instance, they've had all these issues going on, scandals, corporate scandals, we'll call them, and, that can affect the stock negatively. So when a stock drops like that, and when there's a big gap between the current yield and what historically, recent historically has been accepted, there's something going on there. So when we look at that, when I talk about that, when we get into the valuation, where I get that number from is right here. When you go to Morningstar, you go to the valuation tab, you're looking at dividend yield, 3%. You're looking at the 5-year average, 1.8%. So there's a spread of over 100 basis points here. So what investors have been willing to typically accept from Grainger, 1.8%, that's the yield they've been typically willing to accept. They're now accepting a yield of over 3%, and we see where that came from. You see a big drop off in the stock right here. So that's where a lot of that's come from is recently. And as Amazon Business moves in, and as this industry becomes more competitive, and as and Grainger's been talking about in some recent reports about margin compression and some concerns about price competition and their customers having more access than ever to pricing and things like that. So that's going to affect the business. Should you have accepted a 1.8% yield on Grainger over the last 5 years? I don't know. That's maybe a good question. So some of this gap between what investors have been willing to accept and what they're accepting now in terms of yield is I think reasonable. I mean, I don't think this 1.8% was a good idea. I mean, I don't think you should have bought Grainger accepting a yield of 1.8%, to be honest with you, because, there's just, the e-commerce threat is not new. I mean, it's something that's been moving along for years now. So when you look at that yield and you look at the growth rate of Grainger and you start to kind of put the numbers together and you say, well, I want to limit my risk as much as possible. Is getting a yield of 1.8% where you want to be, and then you've got the PE ratio right here of over 21 on the 5-year average. So that's a pretty premium price stock for something that is a distributor with certainly a threat to margins. Maybe not the business model. I don't think GWW Grainger has a threat to its business model, but certainly a threat to the margins. Which, the lower the margins, the lower the profit. The more they compete on price, the less growth they can possibly experience, unless they're limiting margins by taking out competitors and expanding market share or something like that. But all this stuff here just strikes me as kind of a little pricey. So some of the drop in valuation seems warranted, but the article I wrote basically highlights that, but also says that some of that seems a little excessive. And that's where you got to make that judgment call, is when you see a big drop in valuation, is it excessive or not? And that's where you got to do the analysis and look at the overall business. So I talked a little bit about that spread between current valuation and recent historical valuation in terms of the yield, with the yield being so much higher than it has been over the last 5 years on average. So when I wrote the article, that current yield was more than 130 basis points higher than the stock's 5-year average yield. So again, that's just something where investors are kind of scratching their head and saying, what, we need to maybe take more income from this stock, and we need to drop that valuation down based on some of the ongoing concerns. So I talk a little bit about that right here in this part of the article. And in order to really get a good idea of what kind of dividend growth to expect moving forward, I mean, the first thing you want to look at, obviously, is what they've done, historically. So we know the 10-year dividend growth rate is 15.8%. We know that's decelerated somewhat significantly down to the mid-single digits. We know we've got a pretty moderate payout ratio, very reasonable. We know we've got 46 consecutive years of dividend increases here, and we know we've got an appealing yield. So we know all that. So with this 46 consecutive years of dividend increases, obviously Grainger's very, very committed to the dividend increases. They're very committed to a sustainable dividend. They're very committed to paying shareholders a dividend. So do we really need to worry about that? Probably not. As long as they have the wherewithal to pay the dividend, they're going to pay that dividend. And when we talk about the wherewithal, we're looking at the payout ratio, and then we're looking at underlying growth of the business, which we're going to get into in just a moment. And then we've got the yield right here. So we know we're getting an appealing yield. That yield, I mean, when you talk about compared to the S&P 500 yield, you're getting a pretty significant spread between GWW Grainger's yield and the overall market, which is down here near 2% or so. So, Grainger's offering you a lot more income, a lot more bang for your buck, if you will, if you're looking to invest your money and get income back. Whereas Grainger used to offer a little less maybe than the market, they're offering quite a bit more now, which puts them at kind of a more compelling and a more appealing long-term investment idea. So in order, again, to take a look at what to expect for dividend growth moving forward, which is part of the valuation of a business. When I value a business, I'm doing a dividend discount model analysis, and I have to, when I'm using that analysis, a key part of that analysis is estimating what kind of future growth to expect from a company in terms of its dividend growth. Where do I think the company is going to be able to go over the long haul in terms of growing its dividend? And so building that expectation comes from a lot of different numbers. The first part of it is obviously looking at historical dividend growth. Where's the company been going? Where's it been going recently? And then also underlying growth. So we want to look at revenue growth. We want to look at earnings per share growth. And then we want to look at a forecast for near-term profit growth moving forward. Kind of combining all that together starts to tell us what kind of earnings power this company is generating. So the first part of that's the revenue growth, and we're looking at 10 years of revenue growth, which again, Morningstar, as I've talked about before in prior videos, guys, their key ratios tab here, you can kind of pull up 10-year growth. They're pretty accurate with these numbers. You can see 64.18, so 6.4 billion back in 2007. You got a little over 10 billion in revenue, but you can, I pulled up their annual reports, obviously, to do these articles because I don't want to rely on a third-party supplier for that. I want to make sure I go right to the source, but you can see it's accurate. 64.18 right here, right? 64.18. This is their annual report. This is from 2007. And then you've got the most recent information, which I'm going to scroll down here to get away from this business model stuff here. Okay. Scrolled a little too far. Okay, so we got net sales here. We got 10.137 billion, right? 10.137 billion. So I got to take those numbers and basically put them in a compound annual growth rate calculator in order to tell me what kind of compounded annual growth this company is actually generating. So the first number we've got is 64.18, and we've got 10.137, right? And we're looking at 9 periods because the first period isn't an actual growth period, it's a starting point. So we've got 5.21%. That's the compound annual growth rate for GWW Grainger's revenue for their top line, which I've laid out right here. That's a pretty good number, actually. As I've talked about in prior videos, when I'm looking at a mature company, I'm generally looking for mid-single-digit top-line growth, revenue growth. That's a very good number to look at when looking at a mature company. If you're looking at a less mature company, a faster growing business with maybe a higher valuation that you expect much more growth from, you'd be looking at a revenue growth rate compounded, definitely upper single digits, if not double digits, if not low double digits. But for a company like GWW Grainger, a little over 5% is very acceptable, actually very appealing. That's a very solid number. I have no problems with that personally when I'm looking at valuing the company. And then we want to look at bottom line growth next. So we're looking at earnings per share growth. And so the prior annual report here, you can see the numbers, and you see Morningstar put their number down 4.94 here. You see 4.94 diluted earnings per share, and the most recent annual report, you've got again 9.87. You've got 9.87. So those numbers are pretty accurate for the most recent annual report and the prior annual report for 2007 numbers. So when we put these numbers in, we've got 494, we've got 987, still 9 periods. We're looking at compound annual growth of 8%, which I laid out right here, 7.99%. That's, again, very solid numbers. That certainly supports the dividend growth they've been generating at least over the last few years. I mean, that 10-year dividend growth rate where you looked at over 15%, their earnings per share growth rate was not matching that. So they were expanding their payout ratio to accommodate that, which that really can't continue to occur, at least not at a great rate going forward. I mean, again, the payout ratio has some room for movement, but, let's see. We can kind of see, if we pull up Morningstar here, we can see what they were working with. Yeah, if you were looking at it 10 years ago, their payout ratio here, you can see at about 27%. I'd have to go through the numbers to pull out exactly whether that's accurate or not. As I was talking about just a moment ago, Morningstar is usually pretty accurate with a lot of their numbers, but let's say it is, below 30%. There's definitely been an expansion. You see 27, 31, 32, 35, 40, 42, now over 50. So there's definitely been an expansion in the payout ratio because we see it in the numbers. Their dividend's been growing faster than their earnings. That said, if they can continue to grow their earnings anywhere near this rate going forward, then the dividend should be able to grow at least that fast. If not a little faster, as I said, the payout ratio could probably expand just a little bit. But we do see a little bit of a gap between top line growth and the bottom line growth, we see some excess earnings per share growth right here. So revenue's growing at about 5, earnings per share growth coming in at about 8, and that can be explained largely through the share repurchasing, which you can see right here. You see shares 85 million, 61 million. You can see those pull up right here. You see outstanding shares down here diluted, a little over 85 million, a little over 60 million. And when you take those two numbers here, minus the 61 divided by the starting point. So you've got a reduction in outstanding share count by about 28%, which I should have laid out, yeah, right here, by approximately 28%. They've reduced their outstanding share count, which is pretty substantial. A lot of the large cap mature companies that maybe have, they have a lot of levers to pull, but they also have limited growth opportunities. But one of those opportunities, especially in a low interest rate environment like we've had over the last few years, they've taken on some debt and they bought back stock. Equity is typically more expensive than debt, especially over the long haul, and especially in an environment like we have right now where, interest rates are so low. And that's what's happened with GWW Grainger. They bought back a lot of stock. They've reduced their outstanding share count, so the float is down quite a bit, and that's driven some of that excess bottom line growth. A lot of times too, you'll see some margin expansion, but that hasn't really happened with Grainger. It started to occur, right in here, guys. You see some gross margin right here. You see the operating margin here. You see some expansion, and then you see a drop again. And that recent drop is what kind of corresponds with the stock drop. The margin I'm most concerned about typically is net margin. You see an expansion, and then you see it pull back. I would expect that to pull back probably even more with Amazon Business coming in the picture. If their net margin comes down to 5, 4, 3%, that wouldn't be highly surprising. Can they hold the line here? Maybe, but they're definitely competing more in price than they have been over the last few years. So something definitely to keep in mind going forward. So I talked a little bit about where the excess bottom line growth came from, which is really just the share repurchases. I mean, and I kind of put that in perspective for you readers. So we talk about they've got a share repurchase plan outstanding right now. They've got share buybacks occurring as we speak, and the current plan right now is $3 billion. So GWW Grainger has authorized up to $3 billion in share repurchases to occur over the next 3 years. For perspective, that's about a third of the company's market cap, which I talked a little bit about earlier about where this company's at. It's a $10 billion company. It maybe was 12 or 13 before the pullback. But where they're looking at now, when you think about share repurchasing, you'd much rather have a company repurchase its stock at $165 versus $255, obviously. So some of this drop, I think, is excessive, number one. And number two, I think it's actually going to be accretive towards earnings growth because the company's buying back stock at a much cheaper price. So some of that drop, I think, is just investors being fearful. I think some of it's rational. Maybe to see the stock drop to maybe 200 or so, but getting down to 165 in that area, that's a pretty strong drop, and really quite quickly, because it was just a few months ago that it was well into the mid 200s, and now we're in the mid 100s. So that lopped off a huge chunk of the stock very, very quickly. Again, some of it seems rational, but some of it seems excessive. Nonetheless, I'm almost always happy, and I've written about this before, I'm almost always happy to see a stock price decline, whether I own it or not, especially if I own it, because I want companies and a lot of the companies I invest in are buying back stock routinely. I'd much rather them buy back stock at a cheaper price rather than a more expensive price, obviously. So, that means that share repurchase plan is just going to be more effective, over the long haul, because they're taking stock off the books at a much cheaper price, so their dollars going much further. It's just like if I'm going out buying stock, I'd much rather buy stock at $40 a share versus $50 a share. So that just like it positively impacts me as an individual investor, it positively impacts the company. It works the same way. So we talked a little bit about where their historical growth is at. The next thing I want to get into, obviously, is future growth, and this is a guess. I use CFRA's numbers. I've talked about that in the prior videos, about where they get their numbers and why I use them and everything else. But in the end, it's a guess. It's an educated guess. It's a professional guess, but it's still a guess. So we kind of have to take that with a little bit of grain of salt. But where we're getting that number from, We're getting up at the top right here. So I'm talking about 3-year projected earnings per share growth compounded out. So CFRA believes that WW Grainger will grow its earnings per share, will be able to compound its earnings per share at an 8% annual rate over the next 3 years. And we see their S&P quality ranking right here in A, which is fantastic. And I include that number right here. So I say, looking forward, CFRA believes that WW Grainger will compound its earnings per share at an annual rate of 8% over the next 3 years. And that'd be right in line with what we see here. They've done 8% compounded growth over the last decade, and CFRA basically just believes status quo. They believe that's going to continue going forward. That might be a little difficult just because of that ongoing margin compression, but I don't think it's unreasonable to expect that either. So, if WW Grainger came in at 6% over the next 3 years, that wouldn't be surprising to me. But if they came in at 8 or 9, that also wouldn't be totally surprising. I would err on the side of caution, and I would expect them to come in a little lower than that. Honestly, if I had to put a number on it, I'd say probably 6-7%, somewhere in that range would be more reasonable. The next thing we get into is the rest of the fundamentals. The main two parts being the balance sheet and then profitability. The balance sheet, I look at two numbers. I look at long-term debt to equity ratio and interest coverage ratio, with the latter being, in my view, much more important. But a lot of people like the long-term debt to equity ratio. It's a pretty common number. It's kind of a bellwether number, if you will, that a lot of people like to use. So I include it in the articles. But I just try to keep in mind there that shareholder equity can be impacted by a lot of things, especially with companies that are buying back a lot of stock, if they have a lot of treasury stock. And you can see here, their treasury stock right down here, guys, WW Grainger. I'm kind of highlighting right here. So that's obviously going to impact shareholder equity, when they're buying back a lot of stock, and that's kind of hanging out there. But if we're looking at long-term debt to equity ratio, we've got 1.8. We've got long-term debt, right here. So we've got a little under $2 billion, right? So 1,840,946. We've got a little over 1.8 billion right there, and then we got to divide that by shareholder equity, which is right down here, 1,797,935. We don't even really have to do the math. You can see that they're almost matching up one for one, but we'll do the math here. So we're a little over 1, and I reflect that in the article. Talk about here, long-term debt to equity ratio is approximately 1, because long-term debt and shareholders equity, they're roughly equal. But the interest coverage ratio, as I note here, is over 16. That's a great number, and where I got that number from, I'll show you. We got to go back to the income statement up here. And then you basically want to know EBIT and interest expenses. So we've got earnings before income taxes right down here. You got to add back in the interest expense to get EBIT. And then you got to divide that by the interest expense. It tells you, how many times over EBIT's covering the interest expense. So we're talking an interest coverage ratio of a little over 16. And again, I reflect that in the article. That's a pretty good number. If you want to look at WW Grainger on the Google Finance, I kind of have highlighted a couple other metrics, fundamental metrics, and you can kind of see where Grainger's at here. You see their net profit margin over here. I'm sorry, that's profitability. We'll get in that in a moment. But long-term debt to equity ratios right here. It's a pretty good number. I mean, I generally consider a number of about 1, a long-term debt to equity ratio of about 1, as I've talked about in prior videos, for most companies that aren't extremely capital intensive, to be kind of line in the sand, if you will. Where if you're much over 1, it's probably taking on a little too much debt. If you're far below 1, then you've got it really just comes down to flexibility in the balance sheet. I mean, the more flexibility you have, the better off a business is, because it allows more potential for M&A, and especially in an industry like this with WW Grainger, where they're at, where you've got little tiny market shares across all these different businesses. I mean, if there's going to be consolidation in the future, where as Amazon Business rolls into the industry, you got to be thinking, if you're WW Grainger, you got to be thinking about consolidation. You got to be thinking about, how are you going to change your business model to compete better? There's a lot of thoughts that got to be, I hope it's going through their minds, because, the board of directors and the management are getting paid a lot of money. So you would hope that they're thinking about this going forward, about where they're going to go. And so the more flexibility you have in that balance sheet, the better off you are. Debt to equity ratio of 1, it's not bad, they have maybe a little less flexibility than I'd like to maybe see them have, but it's and the interest coverage ratio of over 16, that's very solid. They are certainly, and I'm not trying to imply that they have any financial concern whatsoever. They're in great position, but if EBIT were to drop sharply due to what we've been talking about all along, then this interest coverage ratio obviously drops, right? Because the amount of money that can cover the interest expense drops. So you got to pay attention to EBIT there. So the long-term debt to equity ratio is 1, and really that's probably much better than it looks because of what I was just talking about with the shareholder equity being negatively impacted. The interest coverage ratio is really the key metric in my mind, and if EBIT takes a hit, then the interest coverage ratio will take a hit, obviously. The next thing we get into is profitability. So we're looking at net margin, we're looking at return on equity. This is another area where I look at really one number much more than the other. Return on equity is a number, again, it's a kind of a bellwether metric for profitability. I don't really consider it all that important, again, because of that equity part of it. So it's a number you want to look at. You want to say, okay, where are they in the industry? And you can see here return on equity right here. And you see GWW Grainger's pretty far up there, as you would expect from a company with almost 50 years of dividend increases. The clear market leader, albeit in a highly fragmented industry, they are the leader. You would expect pretty strong profitability metrics. And then you see net profit margin over here. They're pretty far up there on that one too. But when we get into that, I've talked in prior videos where you're getting that number from. You can pull up the income statement and net margin. You're looking at, net income divided by revenue times 100. Net earnings, let's see here. Net sales. Yes, you're basically just taking net earnings, 632,838, dividing it by net sales, a little over 10 billion. You're dividing the two and then multiplying by 100. So you're getting a net margin of a little over 6% right here. But the number I use in the article is a 5-year average, and where I'm getting that number from on the CFRA report again, you can pull up the 5-year average right here. So it's 7.58% and 26.73%, right? And we pull up the article, you'll see, yep, 26.73 and 7.58. But when we're looking at the most recent reports, we're seeing definitely a drop in that net margin, which, as I talked about earlier, is certainly not surprising with everything going on. So, and to expect further compression in that would not be a huge surprise, which I think limits that potential future growth, which again speaks to that CFRA estimate of 8% going forward. I think that's probably a little aggressive. I would expect that to drop, a little more. So just some things to keep in mind here. And I talk a little bit about the industry as a whole, where everything's at. A continued move to e-commerce is, in my view, a negative for the company, as I talked about, although they are very strong in e-commerce. And one area that Grainger has certainly a lot of potential for is all these industrial centers that they have. When I was working the dealership, as I spoke about earlier, we'd order something online, we'd order something through the Grainger system, and then they'd get it ready, and they'd have someone at this you'd walk in the building. It was just kind of like a glass partition there where somebody would ask you who you are, what you're there to pick up, and they'd go get the stuff for you. But could they build out a fleet of drivers and just start delivering locally everywhere they go? Absolutely. So do they have a competitive advantage over Amazon Business? Definitely. And Amazon knows this because as they recently bought Whole Foods out, they are not as advantaged as some of the legacy B&M businesses out there that already have all these centers, industrial centers and distribution centers, and all the infrastructure already built out. So Amazon's going from primarily an e-commerce company to moving into traditional B&M infrastructure. So the companies that already have that need to take advantage of that, and I don't know if they are at least as fast as they should be. So, but they do have some advantages, and there certainly is some room for consolidation, which will bolster the companies that remain after that consolidation is complete. I expect that consolidation to, if 20 years from now, I would expect Grainger to have a much larger market share, if only because they've swallowed up smaller competitors. That would not be surprising to me at all. I would almost expect that, going forward, because of just where this industry's at. Some players are just going to fall out. If GWW Grainger is going to have a hard time, imagine what the smaller players are going to be looking at. It's something else I keep in mind when I start looking at it, investing in a business. I say, wow, GWW Grainger is the leader, clearly, and they're having some issues kind of competing. Where are these smaller players going to be? that can't compete on price so well because they're not buying in bulk, and they're not getting those. They're not able to they're not able to already start with high margins that can compress. I mean, if you have much lower margins because you're a much smaller competitor, the compression hits you much harder. So, it's something to kind of think about and look at. But we talk about the valuation next, the PE ratio, and where they're at compared to where they have been and everything else. And Grainger here, I have to look at, did they recently change something? Okay, guys, sorry about that. I had to pause the video because I was looking at when I wrote this article, and I was looking at the valuation. The PE ratio was 16.59. I'm looking at Google Finance, and they're usually pretty accurate. That's the finance tool I use most often. We're looking at a PE ratio of over 19, so I thought, well, something must have happened. Grainger must have released earnings after I wrote the article, and they did. This article is dated July 23rd. But I started writing the article, around a week before it was released. So some of the information can change as time goes on. And now we're actually at the end of July right now. So, it's been, what we're talking pretty much a couple weeks now, between the time I put all this information together and where we're at now. So that's why there's been some change. This PE ratio, though, is not really all that accurate because the quarterly report that just came out most recently, actually just a few days after I started writing the article and after I was getting it ready to send over to Daily Trade Alert for publication, there were some adjustments to earnings per share that had to do with streamlining the business, where they're basically restructuring and things like that. So this PE ratio, I don't think it's really accurate. I'm going to continue to use the one I've got on the article because I think that's actually more reflective of the true business. And when we look at that PE ratio of 16.6, basically is rounding it up. When I go over the valuation tab, I talk about this in every article. I basically compare the historical valuation of the company compared to where it's at right now. And so I'm looking at, we're looking at a PE ratio of under 17. Actually, even if you want to use the adjustments and you say, well, I'm just going to use that, even though it's really not that accurate because earnings per share took a major hit, and that's kind of a one-time thing. It has really not much to do with the underlying true earnings power of the company. But even if you were to take that number, which again is inaccurate, the 5-year average for GWW Grainger is over 21. And again, as I talked about earlier, I think that some compression is warranted, but that's a pretty strong drop compared to where it was to where it's at now. So investors are basically saying, well, Grainger's only worth about 16 to 17 times earnings now. It was worth 21 times earning not really that long ago. That's a pretty strong statement saying, well, in January I think the company's worth 21 times earnings. In July, 16. The company didn't really change that much. I mean, certainly there are some risks to consider, certainly some margin compression, some valuation compression, all that to keep in mind, but that's pretty strong, and I think that's excessive. So trying to determine, and as I talked about earlier, obviously the yield is much higher, and I note that here at the bottom, the yield is also substantially higher than its recent historical average. And you can see some other valuation. You can see the price to book, price to sales, price to cash flow. You see price to cash flow. So cash flow is another great metric. If you really want to say what is the company really earning, because earnings per share can be impacted by the adjustments I was just talking about. Cash flow is not. If you want to look at cash flow, I mean, it's significant. We're talking under 10 times cash flow, 5-year average over 16. So that's a pretty big gap there between the two. But in order to determine how excessive this drop off has been, I want to actually value the business. And when I do that, we're using a dividend discount model analysis, as I talked about earlier. And so the first thing I need to know is the actual dividends, $1.28 a quarter. So it's $5.12 a year. And then I want to look at the growth rate going forward. And that's where you're getting into some estimates. What I think the growth rate will be might be different from what you think the growth rate will be. These articles and these videos are not designed to say this is for sure, without possible argument, no room to look at these numbers yourself and come up with your own conclusion. These are for sure hard numbers. You can't value a business and say that. You can only say, look, based on what I'm seeing, based on what the company's been doing, based on what I think it's going to do going forward, this is what I think the stock's worth. And you know, I'm not saying that down to the penny when I came up with the analysis that GWW Grainger is without a doubt worth 182.61 down to the cent. I'm just saying that that's a pretty good estimate from my point of view of what I think the stock's worth. And so the growth rate that I'm using 7%. I'm using a long-term dividend growth rate of 7%. I'm using a discount rate of 10%. And I've broken this out in prior videos where I get the discount rate from and everything else and the dividend growth rate, and just kind of reiterating that growth rate 7%. I'm basically dropping it down. I'm trying to be conservative here. They've grown the business at 8% over the last 10 years. CFRA believes that they're going to continue that going forward. The long-term dividend growth rate is almost 16%. I'm factoring in the payout ratio that's increased a little bit. It's certainly higher than it was 10 years ago. Definitely, we know that, we saw that. But there is still some room to increase that even further. You know, if GWW Grainger 5 years from now had a payout ratio of 60% because the business is only growing at, let's say, 6, and the dividend's growing at 7 or 8, and the payout ratio grows as a consequence, I wouldn't really be that concerned about that. But obviously, you don't want to see it expand too much. You want to see dividend growth rate and the earnings per share growth rate roughly match going forward, because this is a mature business and they are facing some additional concerns and headwinds and whatnot. But there's some room there. So they've grown at 8%. CFRA believes they're going to continue growing at 8%. The payout ratio is pretty moderate. You know, the dividend growth rate 16%. I'm bringing it down to 7 going forward, because I think the business, if they were to grow at 7% over the next 10 years, I'd actually be pretty happy with that. So if the dividend growth rate would match that, keeping the payout ratio pretty moderate, I'd be pretty happy with that kind of conclusion. That's where I'm coming up with this number. But if you want to bring it down to 6% or 6.5% and be even more conservative, if you really think that GWW Grainger isn't going to come anywhere near 8% growth going forward, and you think the payout ratio shouldn't extend any more than 50% or so, then you could drop that down. But I think 7% is pretty reasonable, going out over the next, over at least the next 10 years. I mean, it's a long-term dividend growth rate. It's technically a terminal growth rate, but I've talked about this in prior videos. It becomes almost a rounding error after so many years. And I'm not looking at 100 or 200 years of GWW Grainger growth. I'm really more worried about, the next few decades or so, because I'm not immortal. I'm not going to be alive to see where GWW Grainger is at in 200 years. So when we say long-term and terminal, you got to be you got to kind of use some common sense to be rational about that when you're looking at that. And you're basically just looking for a net present value. And I talked a little bit about why the dividend discount model analysis is what it is, and why I think it's a pretty accurate way to value dividend growth stocks. And obviously, as I talked about just a moment ago, my perspective is one of many, so I like to compare mine to some professional analysis firms. The first one's Morningstar. They rate their stocks on a 5-star system and then give you a fair value estimate. 1 star would be highly overvalued, 5 stars would be highly undervalued, 3 stars being moderately valued or pretty close to fair valued. And you get that number right here. You've got the Morningstar star rating. They give it 4 stars, which that's come up a little bit, I think, since I last wrote the article. Was it 4? It was a 3. So that's come up a little bit since then. And they've got the fair value estimate at 202, which I've got right here. And CFRA, they also rate on a 5-star basis. They've currently got it a 3-star hold, 3-star hold, and they've updated this since I wrote the article. So they've got this on July 19th. They went back through the stock and kind of reanalyzed it. That was after I started writing the article and after I compiled all the numbers. So they've changed the valuation. I looked at this before I started the video. Yeah, they've got the valuation out 160.80. So they brought it down a little bit after the quarterly report came out, I'm guessing. And they had it at 178.60. So I'm going to go through, since we're doing a video, since this is kind of taking a fresh look at things, I'm going to revalue it. So we've got 182.61. Whoop. And just to show you where I got that valuation, you see 182.61 right here on the valuation tab. So we've got the annual dividend, we've got the long-term dividend growth rate of 7%, discount rate of 10%, 182.61. So you can see where I came up with that from, 182.61. You see the numbers match. But I'm going to take the 3 numbers and kind of re-average them together. We got 202, and we got 178.60, divided by 3. So the new valuation would be 187.73. Whoop, I'm sorry. I used the old number again. My bad, guys. 182.61. 202. I was thinking, wow, that didn't change. What happened? And we've got 160.80 divided by 3. 181.80. It would be 181.80. And looking at where the stock's now, which actually I think it's come up a little bit, as I said earlier. Minus 165.23. So it'd be closer to 10% undervalued now compared to where it was when I wrote the article. So the information's a couple weeks old by the time I get around to doing these videos. You know, I start writing the article at one point, the article's actually published, and I do the video maybe a week or two later. So there's sometimes a 3 to 4 weeks of lag in between all of this. But it still looks undervalued. It's still a very, very good business. It's still offering a yield of over 3%. You know, I think that there's still a lot to like about the company. The only thing that really changed with the valuation, Morningstar's numbers are the same. My numbers the same. CFRA came down on it a little bit. CFRA, I actually like Morningstar a lot better. CFRA, they seem to change their numbers all the time. I'll pull up a stock one week and it'll be one number, and the next week it'll be a different number. And sometimes earnings don't come out, nothing changes. You know, just another week in business and the number will go up or go down, just, you know, and sometimes significantly. So a little grain of salt there with CFRA's numbers. I like Morningstar because they update generally just once a quarter. As quarterly numbers come out, they may adjust that up or down a little bit. They also include the time value of money. Of course, a business becomes worth more, you know, based on time value of money. So it may move up like 50 cents or a buck or something like that, which would be a realistic look at things. Excuse me, the CFRA numbers, they'll sometimes radically go up or go down, seemingly for no reason at all. But for them to come down after the quarterly report, you know, I don't think that's a bad thing, assuming that they weren't factoring in the adjustments to earnings per share, which had really nothing to do with the underlying earnings power of the company. Excuse me, I have something in my throat. So we've got the final valuation. It changed a little bit between when I wrote the article and when we're doing the video. So instead of looking 16% undervalued at the time, it now looks 10, which is mostly impacted by CFRA's valuation. That's the one really dragging on the end number. So that's the only thing when you're averaging out three numbers. If any one number is way, way, way off compared to the other ones, then it can impact things. But, you know, they're really not far off. I mean, actually, if anything, you could say Morningstar is maybe too high. My number is 182. CFRA number is now 178. And you could say, wow, maybe Morningstar is a little off there, at which point the stock would look a little less undervalued. Anytime I'm looking into buying a business in terms of where I want to be when I'm thinking about it being undervalued, I want to look for at least 10% undervaluation. If a stock it only looks 5 or 6 or 7% undervalued, you know, single digits, that's really maybe not the margin of safety I want to look for. And I've written articles about this, about how I think that the dividend discount model actually, you know, has a triple margin of safety, but one of those is the end price you're paying. So if you think a stock is only 5 or 6% undervalued and you buy it right then and there, if that growth rate was a little off or something's off with the dividend discount model analysis, you could very quickly be paying full price or even maybe a little too much. But when you start getting into 16% undervaluation, as it was when I wrote the article, or 20% undervaluation, or 30% undervaluation, your margin of safety just grows as a consequence, and that gives you a lot more wiggle room, you know, before, you know, maybe the investment becomes upside down on you, or, you know, if your valuation was a little off, you've got a lot more room to kind of play with there. So if maybe you valued it 15 or 20% too high, if you bought it when it was 30% undervalued, you still got 10%. You still got a 10% gap there, which is really nice. And then I break it down the bottom line here about why I think GWW Grainger is a pretty appealing investment idea here. Is it the best idea in the whole stock market? You know, that would be up to you to decide. But I think it's a very, very, very solid dividend growth stock. I mean, the 46 years of dividend increases, I don't see that changing anytime soon. I think GWW Grainger will hit 50 years of dividend growth. I think they'll hit 60 years of dividend growth. They're going to keep increasing that dividend. That's going to happen. So if you are looking for a stock with a 3% plus yield, and you're looking for something pretty rock solid, and you're looking for a company where you can pretty much count on the next 10 or 20 years of dividend increases coming in, you'd be hard pressed to find a better example in GWW Grainger. I mean, they're giving you all you're looking for if that's what you're after. So just some things to keep in mind here. So I hope the Video provided some additional perspective on the article. I'm sorry some numbers have changed. Again, there is sometimes a lag here. GWW Grainger came out with a quarterly report. CFRA changed their numbers downward as a consequence. So some of the numbers look a little different, but you can see where I came up with everything otherwise as far as the fundamental numbers. But I hope the video provided some additional perspective and value for the article. I hope it complemented some of the things I was talking about. I want to provide some additional color commentary on where the business model's at, where I think it's going to go, some of the risks, but some of the maybe the drop in the stock price being excessive. And I think that over the long haul, I think WW Grainger looks like a pretty solid investment. I personally have some exposure in this industry via Fastenal, but WW Grainger is a very, very strong business. It offers a very appealing yield, certainly a market-beating yield right now, and growth. Even with a little bit of margin compression, there's still plenty of room left over. I mean, we're talking about a very fragmented business here, or sorry, very fragmented industry, where further consolidation seems highly likely, which bodes well for the stronger competitors, eating up the smaller players. So I hope it provided some value. I appreciate your time, guys. Thank you very much. Have a great week. Thanks. Bye.